Hello, my name is Peter Quinn. I'm a senior vice president and shareholder of Kidder Matthews, a Seattle-based commercial brokerage firm, which happens to be the fastest growing commercial real estate firm in California. With me today is Jamie Dick. Jamie Dick is a senior vice president with Kidder Matthews and runs our structured debt and equity division here at Kidder Matthews. Jamie services all of our offices throughout California. Jamie, how are you today?
I'm fine, thanks. How are you doing, Peter?
Good, good. Say, tell us a little bit about yourself.
Well, 40-year veteran of the business. I like to refer to myself as a recovering banker, which I did for 20 years, and then transitioned into the mortgage banking arena, which is where I've been for another 20 years. So I've kind of done a lot, seen it from a number of different sides of the table. Work with my son, who joined me 8 years ago as a team, and we do all sorts of debt and equity placement assignments from Kidder Matthews clients and others, and work a lot with our broker colleagues like Peter.
So our topic today is the current interest rate environment. And you're the perfect guy.
Oh, yeah.
to go through this. So you and I both been through a number of recessions and interest rate fluctuated environments. So I'm going to roll through some questions, and please do your best to give us some answers. So when did you first realize that interest rates were finally rising?
Believe it or not, I actually know the day. It was January 2 of this year. And the reason why I mentioned that is because, we do, like everybody, we always kind of look at things kind of before the end of the year, after the beginning of the year, New Year's Eve, et cetera. And so, and being in the mortgage business and the finance business, I zero in on interest rates, and I made a note of where interest rates closed January 31. So, and that was a 10-year Treasury, which is kind of the benchmark that we normally look at, and it closed at 1.8%. And my comment to myself and to some other people at the time was, well, we'll see what happens, next on the second when we come back to work and the markets open again. See if there's any move. And in fact, there was a pretty significant move just that day, and that was when I really felt that rates were going to start moving upward at some speed. And as it's turned out, I was correct.
So you look at the rates on December 31st in 21, they're X, and they moved how many basis points between the end of the year and the first business day?
10 basis points, and which is a big move on a daily basis. And it was just the beginning of a continued upward move on at least the 10-year Treasury, which is the benchmark that most commercial real estate loans are priced over.
How long had you been waiting for that move?
About 10 years. And that's what I used to say, that, even a broken clock is right twice a day. All the things that you normally look at in the economy that would cause rates to rise have been in the marketplace for years. But the government had done an amazing job of keeping rates down for various motivations and reasons. But eventually, and I had told clients many times, I think rates are going to move over the next 6 months, and I was wrong. But they did start moving, and they've continued to move up to including today, right now.
I mean, I know in talking with you over the years, we would, look at certain things happening in a variety of financial, real estate, and other markets and go, well, interest rates are going up for sure now. And
Right.
then they just never did. So what set of circumstances do you think was the cause of interest rates to go up from December 31st to January 2nd and then continue to rise to today?
Well, when we talk about interest rates rising, I think it's important to step back and realize that we're talking about two different sets of interest rates. And the one that gets the most notice and is in the news the most is short-term interest rates, which are controlled by the Federal Reserve. That's their overnight rate that they lend money to banks at, and they are in complete control of the pricing. The other, though, is the 10-year Treasury or Treasuries in general. Mostly the 10-year is the focus, and those rates are dictated by market pressures, investors who buy and sell 10-year Treasuries based on how they see the economy and where it's going. And so initially, at the beginning of the year, the Fed was talking about raising its interest rate, but it hadn't yet. But there certainly was noise in the marketplace. And that certainly caused investors on the long end buying treasuries and selling treasuries to start kind of hedging their bet and beginning to start selling some of their positions. And that results in an inverse way that rates begin to rise. That's how it really started the first week of January.
When we come back, we're going to talk about what effect injecting trillions of dollars into the U.S. economy may have had on the interest rate environment we're in. Hold on. Jamie Dick, Senior Vice President of Kidder Matthews, head of our Structured Debt and Equity Group. He does much more than that, of course. So, Jamie, what effect did injecting trillions of dollars into the economy have on the U.S. economy?
Well, it had a huge impact. Initially, it caused, well, make it real simple. By injecting capital into the marketplace, it dampened interest rate rises because what was happening was the treasuries, the U.S. Treasury was actually buying. They became an active buyer of 10-year Treasury bonds. And the more buyers you have, and the imbalance between buyers and sellers, rates go down or stay down. And that was a big impact. The fact that you're putting trillions of dollars in the economy is very inflationary. The old adage, inflation is too much money chasing too few goods. And there was a lot of money added to the marketplace.
What effect do you think COVID had on the economy?
Huge, but it was a kind of a step-by-step process. COVID initially, it was the shock factor, and that causes everybody to kind of freeze. And remember back in the day, when really nobody knew what was going on. We're all flying blind. And that obviously is very disconcerting. So people kind of freeze because they're not sure what to do. And that causes, a slowdown in the economy. People stop buying big items. They might run off and buy a bunch of toilet paper, paper towels. But other than that, everybody gets very, very cautious. Then what happens is that as we get more and more knowledgeable on what COVID was all about, then we began feeling more and more comfortable. So you have this thawing of the frozen landscape. And now, we've really rolled back out economically, it's full speed ahead. And this is what's caused a lot of inflation right now, because all that money the government sent out, people basically just put it in the bank and didn't spend any money. And now they have all this money and now they're feeling comfortable and suddenly everyone's out buying things. And that's been a big impact on the inflationary pressures, which causes interest rates to go up.
And I suspect the fact that we had the supply chain issues, which have been plaguing economies all over the world, had some impact on that as well.
Absolutely. It's remember what it's the only part of Econ 101 I remember: supply, demand, and price, and the lines crossing. If you've got at the same time the federal government sending checks out to every single person in the country, not insignificant checks, and that money is entering the marketplace, all new money. At the same time, the goods that are available to be bought are shrinking because of the supply chain issues. You have this kind of perfect storm that causes an inflation in pricing of items, and that's what's happened. And it's been a big pop and a surprise, at least
So
to the guy.
is this an example of a single black swan or multiple black swans?
Well, I'm not really sure how to answer that. It's certainly, I think, a number of factors happening at the same time. Some are, more significant than others, but they all add up to the net effect. You've got more dollars chasing fewer goods. That pushes up inflation. That all by itself. And but you also have this kind of pent up demand where we went through a couple of years of trying to figure out how to get out of the COVID clutches. And finally, we really feel like we're making progress. Looking at all the metrics, everybody's confidence rises, and all at once, the floodgates open up and people start buying things. And, add to that, unemployment very, very, very quickly recovering from pre-pandemic moments. And, once again, we have this very, very, very tight market for employment. And so everybody's got a job. Everybody suddenly has, oh yeah, I have that money I got from the government. They run out, want to buy this and buy that. At the same time, the things that people want to buy, which a lot of them are big items like cars, appliances, are severely impacted, the delivery of them, the availability of them by the supply chain factors that you talked about, Peter.
Is the U.S. economy in better shape than all of the economies in the world, most of the economies, some of the economies?
I would say yes. I would say that the question was relative to other economies. I say yes. I think the U.S. Economy is more diversified. It's more market-based as opposed to centrally controlled like Russia or China. And I think in the long run, that gives us a huge advantage. And the U.S. dollar is still viewed as the number one currency. So I think yes. Now, are we having challenges? Absolutely. And will we continue to have challenges? I think so. But on a relative basis, I think we're in better shape.
So I'm a commercial business owner. I've got a 25,000 square foot industrial building that I want to go get financing on to either refinance or acquire. Where are the commercial interest rates today?
Well, it's very property specific and loan request specific, but in general, for 7 to 10 year fixed rate money, you're somewhere between 4.5% and 5.5%, which, if you historically go back, is still a fantastic rate. It's just that, when you're used to 3% and suddenly it's 5%, you feel like you're being punished. And but I'd say 4.5% to 5%.
So what would you advise me? Shall I wait for interest rates to come down, or should I go ahead and lock that loan in and get it done?
Well, this is a conversation I have with every one of my clients, and I always tell them that I don't have a crystal ball. I don't know what's going to happen with interest rates, other than the fact that they're going to fluctuate. And the joke that I always say is that the one thing I can guarantee is the day after you lock your rate, rates are going to go down. But to answer your question specifically, what I tell clients is this: when you get to the point where you can actually pull the trigger and lock a rate, and that depends on which lender you're going to, how they do it, what their process is, etc. But when you get to the point that you actually have the ability to lock the rate that day, you call your lender and find out what the rate would be if you lock the rate that day. And if that rate works for you, do it.
Got it.
Once you do it, you've taken all that risk off the table. Will rates go down the next day? Maybe. Doesn't matter. You've made your decision. You've taken all the risk off the table of interest rates moving on you, which can impact not only what your interest rate is, but also how big your loan is. Rates go up, a lot of times loans go down
Right.
in amount. So taking all that off the table as soon as you can, I think is important, because in my opinion, from a long-term point of view, the direction of interest rates is up.
So I know that you don't deal in this on a day-to-day basis, but what about the residential market?
Well, it's a completely different market, and tell you the truth, I wouldn't know how to arrange a residential mortgage. It's a very different discipline, but interest rates impact residential loans exactly the same way as they do commercial loans. And the key, I think, is when you go to refinance your house and you're trying to decide which lender to pick, which broker to work with, perhaps, it's no different than if you're doing it for a commercial loan. The most important thing today is to find out when you're going to be able to lock your rate. Some lenders will let you do it day one. Some lenders won't let you do it until the day that you're going to actually fund the loan. So it's really important to know that upfront. Be a big part of how you select your lender or who you're working with.
As a percentage, how much have interest rates gone up from April 29th, 2021 and April 29th, 2022?
Well, actually, interestingly, where the rates were at the end of the year was pretty much the same as where they were last April. Their rates were very stable for an extended period of time. And that was why there was so much activity in commercial real estate, people buying and selling, because that's what happens. That's the environment you need, stable interest rates. But I can tell you, since January 1, the 10-year Treasury has gone from 1.8%, 1.80 to today 2.91, or in a percentage point of view, it's gone up 61%
Wow.
in 4 months, which is
Wow.
massive, and it takes everybody's breath away. But what will happen is they will stabilize. I think normally when you have, in the times I've gone through situations like this in my 40-year career, when you kind of have this turn in the market, the first 3 to 6 months are the most volatile, and you see the biggest moves in the upward direction. After that, a little bit of air has been taken out of the balloon, and things slow down a little bit and maybe even stabilize. So it wouldn't surprise me, even though everybody gets very upset and says rates are going to go up, 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 up. I think they're going to probably continue to be very volatile for a couple more months. And then I think as we get into the summer, it may actually settle down. The big wild card, of course, today is what's going on in Europe the ground war there. That's a complete unique situation that we've never experienced before, or not in a long, long time. And we really don't know exactly how to handle it. And so a lot of people are hedging their bets, being extra cautious because of that. And that affects interest rates and bond buying, and impacts stock market as well. Because generally what people do is they say, I'll sell my stocks, I'll sell my bonds, and I'll just take, increase my cash positions, put it in the bank, just, in a worst case rainy day type of scenario.
Yeah, we're going to have to depend on the history books to find out how this story ends. One last question before we go.
Yes, sir.
Are we headed for a recession, or are we in a recession?
Well, technically you have to be in a downward movement in the GDP for, I think, 2 quarters to be in a recession. I think, to answer your question, I think we are going to go into a recession, but I personally think it's going to be very mild, and I think it's going to be short, at least in the United States. And I can't speak for the rest of the world. And the reason why I say that is because of our employment situation. We have record low unemployment, and I don't see that changing. And so that's going to provide a floor to any type of recession pressure. People are going to have jobs, they're going to have income, they're going to have spendable, cash, and so that'll dampen things down. And I think the recession will be mild, and I think it'll be relatively short.
Jamie, I really appreciate your time today. It's great information. Your years of work in the financial markets really add a lot of credibility to this story. I'm Peter Quinn. I'm with Kidder Matthews here in San Diego, California. And we've been spending the morning with Jamie Dick, Kidder Matthews, San Diego as well. Thanks, Jamie.
Thank you, Peter.